While retail investors watch the daily swings of the stock market, a sovereign-level war for global liquidity is playing out completely out of sight. For decades, the foreign exchange market has been the foundation of international trade, moving $9.6 trillion every single day through a network of gate-kept legacy banks. That foundation is cracking. A parallel shadow FX market, powered by dollar-backed stablecoins, is siphoning liquidity away from these traditional banking nodes. The Bank for International Settlements warns that this migration is now massive enough to strain traditional bank deposits and disrupt the flow of capital that banks rely on to operate. The dominance of these digital dollars has forced the French finance minister to urgently demand a euro-backed stablecoin just to prevent the complete dollarization of the European digital economy. This shift threatens the very mechanism of central banking. When liquidity moves to private ledgers, central banks lose the ability to influence the economy through interest rates or money supply controls. In this scenario, the traditional banking system becomes a hollow shell, and those left inside it become the ultimate exit liquidity. To see where the power is shifting, we have to look past the official warnings and track exactly where stablecoin issuers are deploying their capital. Tether recently funded the UAE-based tokenization firm Caio with $8 million, specifically to build the blockchain infrastructure required for institutional funds. This allows Emirati oil wealth and sovereign funds to move directly onto the blockchain. It creates a path for trillions in capital to bypass the delays, friction, and oversight of Western banks entirely. Tether followed this by taking an 8.2. Tether is simultaneously controlling the fiat entry points in the Middle East, the supply of the digital dollar, and the computational power that secures the network itself. Moving capital through these shadow markets involves high-stakes risks. Transacting outside the traditional system exposes investors to protocol failures, frozen assets, and sudden legal clawbacks. While retail traders often face total financial ruin in these moments, elite investors utilize a specific provision in the tax code, Internal Revenue Code Section 1341, to recover their losses. To trigger this claim of right credit, an investor must be legally forced to repay more than $3,000 of income they already reported and paid taxes on in a previous year. The IRS lets investors refigure previous taxes without the clawed-back income. A $200,000 tax overpayment becomes an isolated credit. They apply that exact amount to Schedule 3, Line 13Z of their current return, writing I.R.C. 1341 to claim it. This forces the federal government to refund the taxes paid on the lost profit. It effectively uses the IRS to hedge the downside of a volatile, unregulated market. We are witnessing a divergence in global finance. Legacy institutions are fighting to maintain their monopoly on liquidity, while private entities build a parallel ecosystem of tokenized wealth and sovereign-level infrastructure. This transition will be defined by volatility and a continuous wave of regulatory crackdowns as the old system attempts to regain its footing. Market crashes and legal clawbacks are the mechanisms that transfer wealth from those reacting to the news to those who understand the structural loopholes. The choice is to remain a participant in a shrinking traditional market or to start structuring your capital like an institutional insider to master the new system.